Hi folks, welcome back to part 2 of our video on this very long problem that deals with A.J. Smith Company. You'll remember we left off at transaction 7. We have 14 transactions in total. So now let's go into transaction number 8. So in number 8, what it's saying is that there were payments that you made to suppliers that totaled $205,000. Now you might remember in item number 5, it said here that you had bought inventory from suppliers on account. So clearly you're paying some of this off, right? You're paying $205 off. So doesn't that mean that if you're paying your suppliers, the people that you bought inventory from, you got to be paying them with cash, right? So your cash is going down. Cash is an asset. When it goes down, or cash is an asset. When it goes down, assets go down. What else is going down? Your liability is going down. So again, we've got assets going down because cash is going down, and we've got liabilities going down because every time we pay off our liabilities, we decrease them, right? So that means our accounts payable is going down. So when accounts payable decreases, liabilities decrease. When cash decreases, assets decrease. So you can see the left-hand side of this equation, the assets, goes down by $205,000, so do the liabilities. So it means that the accounting equation is in balance. Let's have a look at number 9. Number 9 says that accounts receivable totaling $200,000 were collected. So you'll remember that there were folks up here in number 6, right, who bought from us on account. We increased accounts receivable. Accounts receivable is an asset, but now those guys are paying us what they owe us. So what's happening? Well, if a customer comes in and pays you, that means your cash is going to go up. And you're no longer waiting to receive the money that the customer pays you. Whoops. So that is decreasing, right? So what do you have? You have your cash increasing by $200,000. Cash is an asset. You have another asset receivable decreasing by $200,000. So you've got one asset going up $200,000, one asset coming down $200,000. So you can see that the asset side, the net effect here is 0. There was never any effect on your liabilities and equity, so that means the accounting equation is in balance. Let's have a look at item number 10. Okay, with item number 10, it says here that operating expenses amounted to $50,000, all of which were paid in cash. Clearly, if you're paying down expenses, we're going to decrease cash. Now, it didn't say that expenses were incurred and then we didn't pay them right away. It says we paid them right away, so there's no liability here. Nothing gets set up. So operating expenses, whenever you see the E word, that means expense. So that means your expenses are going up. When expenses go up, what did we say happens? When expenses get bigger, income gets smaller. When income gets smaller, retained earnings get smaller. So therefore, we have retained earnings decreasing. And when retained earnings decreases, we know that our shareholders' equity also decreases, right? That decreases. So we've got an equity decreasing, we've got cash decreasing, so that means assets decrease. So we've got assets coming down on the left-hand side of the equal sign. We've got equity coming down on the right-hand side of the equal sign. Nothing's happening with liabilities. So the accounting equation is still in balance, right? Now let's go look at number 11. This little fella might be a little more complicated to get. All right, so I'm just going to cut that little block out so we can spotlight this row right over here we're going to work on, right over here. All right, so what's happening here? The question says the building, remember this guy here, the building that we recorded at 172.5? It says here it's depreciated using the straight line method with an estimated useful life of 20 years and a residual value of $30,000. So now what that means is that you have to calculate the value for depreciation. Don't forget from chapter 1, we told you that all depreciation was, it was a way of calculating how much of the assets cost, which is 172.5, how much of that cost are we going to allocate each year over each year of the asset's life. And the asset is going to last us for 20 years, they said. Well, if we're going to be able to sell it or dump it in 20 years, or so we think, for $30,000, we're not going to allocate that $30,000, because when we sell it at the end of 20 years or get $30,000, we think we're going to get $30,000 for it. So with that being the case, then we're not going to allocate that over the 20-year period. So we take the cost less the salvage or the residual value, and that turns out to be 142.5, and we divide that by 20. So that means we're allocating $7,125 every year for the next 20 years to depreciation. And all depreciation is, it's the using up of an asset. So in accounting, what we say is that when we get a brand new asset, the more we use it, the less value it'll have to us, right? We use up its value over time. It's just like when you buy a new car. You drive it, you use up its value, right? It's not the same value anymore. Not that it's not valuable to you, but doesn't have the same value. So this is the idea with building and equipment as well. Now, don't forget, when we depreciate, we're not calculating a market value at the end of the period, because what you get for the building is totally different. All we're saying is that based on how we've set the asset up at our cost, less what we think we can get for it at the end of 20 years, we're going to allocate that over 20 years. That's a cost. So whenever you buy these assets, you have to allocate their cost. Now, we're going to be talking about this concept later, but I'll explain it now. The reason we do is because we buy these buildings or this equipment, whatever we're buying, to use in our business. We use it to help us generate revenue. And in accounting, there's a concept known as the matching concept. And here's what it says. It says that when you buy an asset to use in your business, because it's helping you to generate revenue, you have to be incurring a cost. So there's a cost to making money, in other words. There's a cost to generating revenue. So we know there's costs. We know there's human resources costs. There's taxes we pay on buildings. There's all kinds of costs to being in business and making money, earning revenue, right? Well, we say, but our equipment, when we use it, we have to allocate the cost of using the equipment. So this is what depreciation does. It tries to truly reflect all of the costs of running a business, including those that are non-cash. So in this case, what's going to happen? Well, we've got the $7,125. That is going to increase. So the $7,125 means that the building is actually decreasing, right? The value of the building, not market value, but we're allocating out part of that cost of it, right? So it's decreasing, and what's happening here? We've also got retained earnings decreasing, right? And it's decreasing, and how do we know it's decreasing? Because we've got an expense, depreciation expense, which again was explained in chapter 1, but you can go back and have a look at it. They talked about depreciation expense, as I said, being an allocation of the asset's cost. So all we're doing is allocating the cost, net of the residual, over a 20-year period, and that's what this guy is. So when we increase our expenses, we decrease retained earnings. And when we decrease retained earnings, we decrease equity, right? Because we were decreasing or allocating out some of the cost of the building, that means the building's value to us decreases. When the building's value decreases to us, that means assets decrease. So you've got assets going down by $7,125. You've got shareholders' equity going down by $7,125. So you can see that the equation is in balance. Now, We have a similar issue here in number 12. Now they're talking about that equipment that we bought. Remember this equipment we bought in number 4 for $120,000? Well, that little guy's being depreciated now too. So it says here that we're depreciating it on a straight line basis. It has a residual of $5,000 and a useful life of 10 years. So how are we going to calculate the depreciation? Well, what we're going to do is we're going to take the $120,000 that the equipment was worth. We're going to net out from that, because of that $120,000, we're going to recover $5,000. So we can't allocate that out as part of the cost, right? Because the cost was $120,000 to us, but we know we're going to recoup $5,000 of it in 10 years. So at net, it's only costing you $115,000, right? So that $115,000 is going to be allocated over 10 years. However, when did we actually buy it? If you go back to item number 4, it says we bought it in July of this year. So we haven't had it a full year. So when you divide it by 10, that's actually giving you the depreciation expense per year, or for each of 10 years. But we're saying, hey, in 2016, we didn't have it for a whole year. We only had it for half a year. So we're going to multiply it by a half, that's July to December, and get $57.50. So similarly here, you're going to have your equipment decreasing by $57.50, because your depreciation depreciation expense is increasing. Again, when an expense increases, it reduces income, and that means when income is reduced, it's reducing retained earnings. So retained earnings goes down, it means that shareholders' equity goes down. So we've got equity going down here because of this, and we've got assets going down because of this. So therefore, your equation is in balance. Now let's go look at number 13, which relates to dividends. Question said here, dividends of $20,000 were declared during the year and $5,000 were unpaid. So what does that mean? It means of the $20,000 in dividends, we paid out in cash $15,000. So when cash decreases, this $15,000 decrease is for cash. When cash decreases, assets decrease. Right? Now it said that of the amount that we declared, there's $5,000 we didn't pay. So that means it's a liability, because don't forget, I'm not sure if it was in chapter 1 or 2, but they did tell you at one point that, and if they haven't, I'm telling you now, whenever a dividend is declared on shares that a shareholder owns, right, in your company, whenever dividend's declared, it's a legal obligation. You got to pay it at some point in time. You got to pay up. And they're always current assets. Why? Because when the board of directors decides to declare a dividend, you can't wait like 5 years to pay it, right? Normally you found they're paid within 3 to 4 months. Minimum or maximum. Usually that's it. So by definition, they're current. So the idea is that dividend liability, the obligation to pay those dividends, is increasing. So when dividends payable increases, liabilities increase. So what about this? We've got a liability going up by $5,000 and we got an asset going down by $15,000. Well, we can see this doesn't balance. So we're saying, what do we do next? Well, don't forget you declared dividend. We talked about dividends declared earlier in the course. And dividends declared, what do? We declared dividends of $20,000. So that $20,000 declaration will decrease your retained earnings. Why? Because dividends declared is going up. When dividends declared go up, when you start deducting a number that's getting bigger, this guy gets smaller. Is this not so? So you're deducting dividends. So when you're deducting dividends, that means retained earnings is going down. Think of retained earnings as accumulated profit in the business, and don't forget, who has claim to that profit? Not just the company, but the shareholders do, because that's what you use to pay them a dividend. So we're going to declare these dividends out of retained earnings. So when we declare a dividend, The value of the dividend we declared reduces retained earnings. When retained earnings is reduced, shareholders' equity is reduced, right? So now we've got our equity reduced because retained earnings is being reduced by $20,000, and we got our liabilities increasing. So on the right-hand side of this equality, there's your equal sign. We're on the right. On this side at net, you've got your liabilities and equities going down by $15,000. You got your assets going down by $15,000 because your cash went down by $15,000. So now you can see that the accounting equation is in balance. The last transaction we have here is number 14, and it's the interest expense in the note payable from transaction 4 was recorded. Well, remember that guy? Remember there was a note payable of $60,000, and we said that the company was being charged 10% a year. Well, don't forget that equipment was only purchased July 1st, so the note only came into effect on July 1st. So now when we're calculating interest on the note, we're saying on $60,000, there's 10% interest, but that's for 12 months. So whenever you see these interest rates quoted, I get this question often from students. Is the interest only for 6 months? Is it for a year? It's for the whole year. Whenever an interest rate is quoted, it's always annual. Unless they tell you otherwise, which is rare. In accounting, go get a mortgage. They tell you it's 4.25%. It's for the year, right? So the idea is, unless otherwise stated, it's always for the year. Well, you didn't have this $60,000 note payable for the year. You had it for 6 months of 12, not 12 months. This is for 12 months or a year. You had it for half a year, or 6 months of 12. So you allocate it out over the half a year. So we're going to record interest expense of $3,000. So let's have a look at how this works. If you look at number 14, it says the interest expense on the note payable was recorded, but it didn't say that they paid it. It didn't say they paid the interest. So we're going to set the interest payable up, which is increasing. So when interest payable increases, it's a liability, so liabilities increase. But we've also incurred a cost of doing business, which is an expense, which is going up. And again, when an expense goes up, when it gets bigger, net income gets smaller. And when net income gets smaller, retained earnings get smaller. So we've got our retained earnings decreasing because an expense has gone up, and when retained earnings decreases, your shareholders' equity decreases. So we've got equity decreasing and we've got liabilities increasing. So now all the activity is on the right-hand side of the equality, and because it's increasing and decreasing by the same amount, the net effect on the right-hand side is 0. Assets are not affected, 0. So the accounting equation is in balance. Now, the one thing I like to do, now you don't have to do it because the textbook doesn't do it. Previous edition of this version of this textbook did it, and it was a good idea. So I'm just going to share it with you because if you want to check your work, now you'll know how. Add up these increases and decreases. They made it kind of easy for you because they put brackets. The brackets are decreases and the no bracket is an increase. If you net out this column, add it up. It's $170,000. Add up the receivables balance. It's $50,000. So add up the columns and then get your total assets. Your total assets will be the total of all these little guys, right? All these columns. And that's $617,125. I can add up all my liability account balances, and it gives me total liabilities of $120,500, and the same thing with shareholders' equity. I started off with common shares of $300,000 and issued $150,000 worth more. So I've got $450,000 in common shares. And when I do a little bit of plussing and minusing here, I'm going to find I have $46,625 in retained earnings. So my total equity is $496,625. So you can see if I add these two numbers, I'm going to get this. So what this tells me is that I already know what my balance sheet is going to balance to. My balance sheet, the total assets will be $617,125, and the total liabilities will be $120,500. Total shareholders' equity would be $496,625, and these guys would have total liabilities and shareholders' equity equal to total assets, which is $617,125. So I would advise you, and you don't have to do it, but just to make sure before you go do your balance sheet that it's going to balance, is add up the columns, right? To make sure it balances. So now what I'm going to do is I'm going to take a little break right now because we still have a lot more to do in this question. We have to, now that we've done the larger part, now we got to go through the financial statements. We got to do an income statement, a statement of changes in equity. We got to do a statement of financial position, okay? And they said unclassified. So two things here. Statement of financial position is a newer term used for balance sheet. I know students hate calling the same thing by two different names, but they do it. We still do it in accounting. So it's called the statement of financial position by many companies out there now that are following international financial reporting standards or international standards, but you can still call it balance sheet. It's not a problem. It's still a viable term. Well, they said it was unclassified. All that means is they're not separating out current assets from non-current assets. They're not separating out current liabilities from non-current liabilities. So again, you should be fine with that. So we're just lumping them all together. All assets together, not separating current from non-current. All liabilities together, not separating current from non-current. But with the assets, the order does matter. So when we talk about the balance sheet in our next video, you'll see how we put that together. So now take a little break, have a drink, get something to eat, and we'll be back momentarily.